Hi everyone and welcome to today's session. My name's Lisa Jennings and I'm from the Institute of Community Directors Australia, or ICDA. I'd like to start our session today by inviting you to join me in acknowledging First Peoples and their connection to country. In Australia, this connection has been maintained for more than 60,000 years. It exists today and extends into the future. Together we acknowledge the elders and ancestors of country on which we live and work. We pay our respects to elders past and present and recognise and celebrate the diversity of Aboriginal peoples and their ongoing cultures and connections to the lands and waters of Australia. This session on budgeting and finance is the fourth in a series of 5 one-hour sessions on various topics to support you in your role as a committee member in Dysart's community, perhaps in clubs and schools, etc. So while this session is titled Budgeting, we're also going to spend quite a bit of time talking about financial decision making and tools such as reports that will support your decision making when you're budgeting. I'd love to thank you for your attendance this evening and acknowledge that your commitment to your community is really important. I'm here to tell you today also that you don't need an accounting degree to understand financial reports and create a budget. Hopefully the information I'll provide will give you the confidence to undertake your role in helping managing the finance of your organisation. Just for those of you tuning in, I'd like to introduce Grace, who's around to help you out if you're having technical issues. The control panel is in the top right-hand corner of your screen, or it might be in a little bar along the top or the bottom. Whilst you can't speak with me today, you can actually ask questions by clicking on the chat box, and I'm just going to use my cursor there. That's what that looks like. You can also use the chat box. You can also download a copy of the slides from the materials section, and that's that little one there. Remember, today's presentation is also being recorded and will be available for watching at a later stage, so you don't need to be taking notes if you don't want to. If you have any audio problems, you just need to go into the panel there that will help you out there. You can send direct private messages to just the organisers, other participants, or everyone, and the chat looks like the image you can see on the screen. Okay, so let's get started. In today's session, we're going to cover financial roles and responsibilities, reading and understanding financial reports, and then putting them all together to make a budget. So let's think about finances. What are your roles and responsibilities as a committee member of an organisation? You basically have the responsibility to set the direction of the organisation, and that's done through your planning, strategic and business plans. So your strategic plan is the plan of where we want to go in 3 years, and the business plan might be a one-pager that says actually how we're going to do it. Sign off on the specifics through the budget. So you can't just have the treasurer doing the budget. The whole committee needs to have thought about that and actually authorised it. Throughout the year, you also need to be asking for explanations of any significant variance from the budget. So in other words, we set the budget, but then if things aren't happening as we thought, we need to be asking what's going on. And then take those measures, could call them remedial measures, when the budget's going astray. So being across the finances ties into the legal duties of being a committee member. And you can see here the 10 legal duties of a committee member. That falls out of the Corporations Act. Most of you will probably be members of incorporated associations. These aren't actually in your act, but they are your legal duties nonetheless. And the ones that are really interesting when we're talking about finance here is the duty to prevent insolvent trading, and then the duty of care, skill and diligence. In other words, understanding the finances. It's not enough just to go, well, our treasurer understands, let's just go with that, because it is actually your legal duty to understand as well. You'll be as responsible as liable as the treasurer if you're a committee member. The other one that you need to be careful of when it comes to finances, avoiding conflict of interest and improperly using your position in the organisation. So exactly when we say that you need to know about the finances, what exactly do we need to know and understand? So the first one we need to know is what a statement of financial performance looks like. That could also be called a profit and loss. Are we making or losing money? A statement of financial position or balance sheet. What do we own and what do we owe to others? A comparison of budget versus actual. So how accurate, when we made the budget, how accurate is it? How accurate have our predictions been? And then perhaps a forecast to the end of the financial year. What do we think is going to happen? It's really good in some of these financial reports to have commentary on variances and things. Excuse me. So, for example, why has our rent gone up? Why have we got less people coming to our events? Perhaps that was something to do with COVID. What assumptions have we made about the future? Sorry, I've got a frog in my throat. We also should have a cash flow statement. We need to understand that, and that shows us the money flowing in to pay for upcoming bills, and have we got enough to pay the bills as they fall due. And then an up-to-date download of bank account balances. Do our financial statements align with what's in our bank accounts? So we need to be providing a financial framework for planning future activities and operations. We need to be managing transactions. That means knowing the process between the point that we collect money and spend it and how it's recorded in the financial system. Every committee member needs to have a broad idea of how that works. It's really helpful if you understand your financial procedures. Making sure that we use our funds properly. For example, if we do receive grant funds, we need to spend those funds the way that the guidelines of the funder expects it. And we need to have the systems in place that produces these reports that we're talking about, the profit and loss, the balance sheet and the cash flow. And that means we can read, understand and interpret these reports as they come out of our systems. A lot of not-for-profits these days are using Xero. MYOB or QuickBooks is also pretty good. So we'll look at the key reports and break these down further next. However, let's just look at some of the roles that we have in relation to finances. Each organisation will have slightly different ways of doing it, and that will depend on the amount of financial transactions as well as the size and complexity of the organisation. So we usually should have a treasurer, and the treasurer is responsible for keeping and maintaining proper financial records, and they might not even do those records, but they're in charge of making sure that someone does. So you might have someone come in as a contract accountant or something, but the treasurer is in charge of making sure that happens and overseeing those reports that are coming from the accountant. We need to have the treasurer report regularly in our meetings. Every single meeting we should have a financial update. So if you have 4 meetings a year, you should have the treasurer showing the accounts 4 times a year or 12 times a year, same thing, 12 things from the treasurer. When it comes to finances, also the secretary keeps and maintains minutes of each meeting, which includes recording any financial decisions made. And all of the committee members have the legal duty to analyse and assess financial impacts of the decisions, make sure that there's adequate cash flow to finance everything that we've decided to do, make sure we're not trading whilst insolvent, we'll talk about that in a sec, and safeguard resources via appropriate financial controls. So it's important to know when it's time to engage also a professional to do your accounts. If you're getting bigger, then you perhaps need to think about getting some professional help if it gets too much for your treasurer. So we need to be making those financial decisions. Individually and collectively, as before, we're responsible for these financial decisions. So basically, sometimes it's a bit uncomfortable, but it means we just need to check sometimes some of the things that are happening. So our organisation has a lot of free resources, help sheets, policy banks, things like that, and we'll have the link to that at the end of the presentation. This one here is a free one. We call it the decision making tool. So you can download that from our website. In this ability to make good decision links back to our duty of care, skill and diligence. It's really useful, especially if you're going to make a big financial decision. I mean, I wouldn't be doing it every single decision that you have to make, but for big ones, it can really help make things clear. So at every meeting, as before, the Treasurer needs to report on the finances. In a bigger organisation, you'd get the profit and loss statement, the balance sheet, and a comparison of the budget versus actual, and then a cash flow statement. And these will help you with your decision making. Some organisations, if you're really, really tiny, you might just have a profit and loss statement, and then you definitely should have a budget as well. So the profit and loss is really good for actually comparing with your budget. So even if you don't have anything else, you need a budget and a profit and loss statement. The others, as you get bigger, you need as well. So here they are, set out on the slide for you. Remember, you can download these slides at any time during the presentation. So if you're not financially inclined, a statement of financial performance, the profit and loss statement, I think of it a little bit like a movie. A statement of financial position, the balance sheet, I think of it as a little bit like a snapshot, a photo. And then the cash flow statement, I think we all understand cash going in and out of the bank as well. Excuse me. So let's look at some of these just really quickly. The balance sheet, it tells you if you've got any assets, shows you what you own or control, what you owe, which are your liabilities, what your equity is, and are we being as efficient as we could be perhaps with all of those things. And here we have the mathematical statement. Assets, liabilities, and then over the top of that, when you have net assets, it's calculated by assets minus liabilities. So you can see there it's a bit like a math statement. Let's start by looking at an example of a balance sheet. Here we have one, we can see it was for 30th of June 2020. We have two columns of figures. We have the previous year of 2019, the current year of 2020. Have a look at where they sit. The earlier year is further to the right. And it's always good when you get a financial statement like this. It's great having 2 years. It's much more useful. It means that we have something to compare the figures against. So let's look at a different section, or the different sections of a balance sheet. So the assets are everything that the organisation owns. So they can be current assets, such as cash and cash equivalent. And in accounting speak, current assets is something that can be converted into cash within the next 12 months. I think that's quite a long period, but I'm not going to argue with the accountants. Non-current assets, which are more difficult to convert within 12 months. And this statement, it might be property, plant or equipment. Trade or other receivables section is important. These are invoices that are due to be paid to your organisation for services or goods that you've delivered. These will sit here on your balance sheet until the invoice has been paid, and then it will appear on your cash and cash equivalents entry. So just be aware here that something that's listed as an asset may be something that you haven't yet received payment for. So once again, the sum here, the total of current and non-current assets added together makes your combined assets in the green. Liabilities, on the other hand, are commitments you've made to external parties or debts owing that you need to pay. And you can see them in yellow on the bottom half of this sheet. As in assets, where there's current or non-current. Current means that you have to pay them in less than 12 months. Non-current might be a long-term mortgage, for example. In this example, the trade actuals and accruals and other payments could be invoices that you still need to pay. The current liability labelled borrowings could be the organisation's credit card, yet the bank loan is non-current for purchase of the building, as before. Understanding the concept of current and non-current is particularly important for not-for-profits, as they often have grants that they still need to acquit, often within a year of granting. So to sum it all up, total assets minus total liabilities equals equity here in green. And it looks like this organisation has lost a bit of equity. It may have been hit hard by COVID, so the safety margin has decreased here. So if you're sitting in a committee meeting and you're looking at the balance sheet, there's just a couple of things that you need to be careful of, especially if you're not a financial person. Your job is still to be asking those questions. So something that would bring up red flags for me is that if the majority of the assets are intangible, that means that they can be very difficult to realise, which means sell, and these values could get you into trouble. So if you're looking at a balance sheet and you've got things like intellectual property and goodwill, that's a little bit of a red flag for me, especially for not-for-profits, because goodwill is all very well, but it's usually realised. In other words, you get the money for it when you sell, but of course you're never going to sell a not-for-profit organisation. So majority of assets are intangible. Perhaps the current liabilities, what we owe, are greater than the current assets that we own. So that would mean that the net equity is in the negative. So we don't have a safety margin. We could be at risk of trading insolvent. That's pretty straightforward. I think most of us would get that. Perhaps our accrued expenses are huge, or our accounts payable are excessive. This could be a bit of a timing issue, but you need to be asking as a committee member, why are our debtors not paying on time? It's really good if we could have somebody whose gig it is to follow up on the bills. It's not enough just to send out lots of invoices and celebrate a great month. Our membership drive something. It's not until everyone's paid that we really can start celebrating. So that was the first statement. Then we've got the profit and loss statement, sometimes called the statement of financial performance or even the income statement. It shows how much the organisation has earned or lost over a period, and that might be a month or a quarter or a year. The idea behind a profit and loss statement is to calculate the net profits made or the net loss suffered over the particular period. And again, we've got one of these great sums. Profit equals revenue minus expenses. Loss equals expenses minus revenue. Here it is set out in a slightly different way. So you'll get these slides if you download them. So here's some example of income that you could have: grants, sponsorship, fees, revenues from events, sales of goods and services. An expenditure might be salaries, even if you're just paying the accountant or somebody to an event company to bring in your chairs, whatever, I don't know. Hopefully you're paying insurance. Excuse me. Utilities, fundraising costs, depreciation on equipment. Don't forget about that. So here we've got that same fake organisation. We can see its performance over a period. Again, we've got the name of the organisation, the type of statement, and the date at the top, and the comparison year. So it's got 2019 and 2020. Let's look at the revenue first. This is all the revenue your organisation has received, and it's good if you can break these down, of course, into different categories of income so you can actually see what's going on. Some organisations break this right down, and some committees may receive statements that are way more detailed than what is submitted to the regulator or the public. So the middle column, that's an interesting one. It has notes. Can you see that where it just goes 1, 2, 3, 4, 5, all of them there, and they're numbered. So these notes, which may be a few pages on from this page, you'll find more detail and further breakdown of information about the entries. So for example, there's a note number 1 next to donations, and that note might be explaining how many donations there were and maybe who they were from, and note number 3 might be explaining perhaps the investment income and the changes in the interest rates, for example. You should always read and understand the notes. Sometimes they're things that the accountant wants to highlight to you, and sometimes the accountant is actually trying to warn you about something here. So yeah, never overlook the notes as a committee member. Okay, and then let's move on to expenses, the second half of this sheet. It's highlighted here in yellow. These are generally overheads or direct costs related to delivering your services. Again, broken down into different categories. And you'll see that the numbers appear in brackets. That's to indicate their negative values. And sometimes it's interesting, different accounting systems, sometimes they're in red as well. And sometimes they've just got a negative beside it. So there's 3 ways of actually showing negative values, and they need to be subtracted from your revenue, and that's how you arrive at the figure at the bottom, which is your total profit or loss. Because the number here is not in brackets, you know that they are positive figures, and you know the organisation made a profit in 2019 and a slightly smaller one in 2020, as you can see there. So this method of accounting is called accrual accounting. In this method, the revenue or expenses are recorded when a transaction occurs rather than when payment is received or made. The method follows the matching principle, which says that revenues and expenses should be recognised in the same period. And this is in contrast to cash basis accounting, where revenues and expenses are recognised at the time the cash is received or paid out. So another way of showing this, in accrual accounting, if you got a grant of $12,000, in accrual accounting you'd put $1,000 every month in, whereas in cash accounting you'd put the $12,000 in May, as we are today, and that would be for the whole year as well. And there's benefits and drawbacks in both types. So some of the questions when you're sitting on the committee and the treasurer is presenting the profit and loss statement: is our revenue sustainable? So we might have received a large one-off source of income, for example, that $12,000 grant, or we might have sold a large asset. It will be reflected as income, but you won't be able to repeat that income in the following years, so you need to be careful of that. Do we have any policies about what we think is an acceptable fluctuation? And do we have policies on investment? We'd be very lucky if we had to have that, but if we did, we need to have everyone agreeing how we deal with that. What is the other category? Sometimes you'll see in a profit and loss statement an other category, especially if there's lots of money or expenses allocated into that category. I'd be asking, hang on, or miscellaneous is what it's also called. I'd be asking what's actually in there. And another question, how are we tracking against this period of time last year? That's one of the first things I look at in a profit and loss statement, looking at these 2 columns. What trends can we see? Perhaps also looking at the expenses and working out what our overheads are and how we can bring down some of these overheads, particularly when a lot of not-for-profits and charities at the moment are looking at merging. So the third statement is a cash flow statement, and that's a retrospective look at where cash has come from and gone to over a set period. It's useful because it actually tells us what the actual cash situation is. A cash flow statement records all transfers of cash and cash equivalents. So a cash equivalent might be stock, for example, and that's easily converted into cash, netball bibs or pencils, something like that. A statement of cash flow is usually divided into 3 sections: operating activities, investing activities if you're lucky, and financing activities, which we'll see in a sec. Cash is all physical cash on hand, literally, as in the petty cash in the office, as well as your balances in the bank accounts. Be careful here. Cash does not equal surplus. Sometimes you'll have cash, but it's not necessarily your cash. It might be even borrowed. So cash equivalents are short-term, highly liquid investments that are easily converted into known amounts of cash with little risk of change in value. So you can see here this last statement, and that's broken down into those details. So again, it's based on a period of time. It's not a point in time statement. As before, the statement of cash flow is broken down into 3 different sections: cash flow from operating, cash flow from investing, and cash flow from financing. So cash flow from operating activities, which is up the top bit there, ideally this will be your principal source of income. If you're not generating cash flow from your operating activities, then you're going to be relying on donations and grants, which is not as reliable. Then we've got cash flow from investing activities, so transactions of property, plants or equipment, and cash flow from financing activities, loans for example, and again shows you have at hand, but it might not be yours. So this statement, in this one, they've used minus or the negative sign instead of the brackets or the red to denote minus amounts. So questions we should ask there: how is cash generated and spent for the period, if it doesn't actually say? Do operating activities generate a cash flow surplus? So this is an interesting one, as many not-for-profits operating activity will always come at a cost, which just means you're relying on fundraising, donors and grants to bring cash into your organisation. Are we relying on investments and financing to cover shortfalls? So we need to be wary if we are. And what are the organisation's cash equivalents? So here's just a slide, as before. You can download this presentation, just showing you the difference between accrual and cash accounting, as we were talking about before. So another point here is that the main difference is in the timing when revenue and expenses are recognised. Accrual accounting, anticipated revenue and expenses; cash accounting, recognised at the time the cash is received or paid out. So red flags on the statement of cash flows. Some more red flags to watch out for when you're looking at these. Negative cash flow from operating activities. That would really make you worry. If we're relying on selling assets or increasing borrowings, that would be a problem. Or large decreases in cash flow from the comparative year. So the fourth financial statement, I guess, and maybe the most important one, is the budget. So the budget is an estimate of future income and planned expenses for a period of time, and usually we do a budget a year in advance, and that you might do that in January, you might do that at the beginning of the financial year and have it starting in July. So budget is a plan for your income and expenses, and it helps protect your organisation and helps you understand how you can resource your future plans. Budgeting is simply the process of planning your organisation's finances for 12 months. It's all the activities you plan to undertake, expressed in terms of money. And it should actually link in with your business plan. So it's your yearly business plan expressed in money. So the committee needs to sign off on what's going to be bought and what's going to be spent. Any purchasing or spending that hasn't been approved is unauthorised and improper if it's not within what has been previously delegated by the committee. So you might actually say that your secretary can spend up to $100 on stationery, and that's okay, but anything more than that needs to be approved by the committee. The Treasurer presents the budget to the committee often, but it's not the job for one person. So preparing a budget should involve the whole committee, and where applicable, it will involve staff if you've got a larger organisation having input into it. The committee has to approve the budget every year. So in addition to considering the risks that I've mentioned, you'd also look at your future plans and ask which of these you'd like to prepare for to include the expenses on any projected income in this budget. Your budget is also a great tool for early warning signs, such as less money coming in than you planned for, and this is easy to see when you set out the income and expenses over the year. So hints for developing a budget. First of all, if you haven't done one yet, I really hope that this will inspire you to do so. It's not that difficult. Gather your past financial performance if you have it, and then break this information into categories. So you've got revenues and income and costs and expenses, and then put in your fixed costs, those ones that don't change, such as your monthly internet bill, for example, and your variable costs, which might change a bit, such as your electricity usage. Perhaps when the sporting season is on, you're using a lot, and when it's not, it's much less. So you'll need to try and predict any likely changes in your income and expenses. And this is where gathering past financial performance helps you, as you can identify trends. Place all the items into a spreadsheet according to the months in which they fall. Now, I'd also urge you, when you're doing this, as a committee together, undertake some of that what if scenario planning. What if we need more volunteers? What if we lose that grant next year? So produce the best case and worst case and most expected case budget for discussion. And then check with your treasurer and or your accountant if you've got one. Ensure the budget is signed off and minuted as accepted before implementing it. So how do we develop it? We get in trouble when your budget doesn't link with your plans. Sometimes you'll get very enthusiastic committee members making a budget and then putting it in the drawer and completely forgetting about it. It's not going to work if you do that. It needs to be actually linked in with your planning. So the budget needs to be linked to our plans and how. One of the things that's also useful for good financial governance is having an asset register. And sometimes people laugh and they say, well, we've got a shovel, that's our asset. But basically, an asset register allows us to keep track of our assets and provides a fair estimate of their worth. It meets your taxation, statutory and sale of business obligations if you're ever going to sell your profit for profit business. It's also an appropriate place to record serial numbers, makes and models, etc. And if you don't have one, please get one. Once again, we have asset register templates on our website, and you can see there the link to that. You need an asset register to process the purchase of fixed assets in accordance with your organisation's authorisation and record keeping procedures. Maintain an adequate accounting record of assets, cost description and where they're kept in the organisation. Maintain accurate records for depreciation. That's when, as you know, when you buy a computer, it's worth $2,000, but within 3 years it's worth less than half of that. That's what depreciation is very broadly. Provide management with information to help plan future asset investments or management or your main volunteers, and record the retirement and disposal of assets as well. So if things get too old, we still need to work out what we're doing with them, because if we just threw it out and somebody picked up perhaps our ride-on mower and had an accident, we would be liable. So it's actually quite important that we know what's happened to them when they're retired as well. So as before, budget years are generally aligned with tax years beginning in July, although we do hear about some organisations that start in January. We've got to do it well in advance. Count back from July. If we're doing it that way, how long will it take to collect the necessary information about planned programs and our relevant changes, new equipment needing to be purchased, grant applications approved? How long will it take to have the committee finally sign off on the budget document? And if this pushes you all the way back to the beginning of the year, perhaps you need to look at the speed and responsiveness of your systems and make some changes. It's important that the process of preparing the organisation's budget involves everybody who's going to be affected by it. Make sure that everybody has been with the process all the way through on the committee. So I begin by reviewing your previous year's budget, what can you learn from it, and how did our estimations go? Did our running costs drift up? Did our cost per client go up or down? Check our plans against the reality of the accounts. Did the budget allow for you to achieve your objectives comfortably? And was there any scope for savings? And are there any changes that could have reduced costs? Then look at the year's plans. Do they include any new activities that you expect will result in increased costs? And then go over each item. What was it last year? Have there been any external changes that would alter this? New tax laws, rising prices, or changed practices, for example? So when you're laying out your budget framework, you need to ask, what are the things we spend our money on? And they might be equipment, rent, electricity, gas, telephone, stationery, photocopying, insurance, advertising, sundries, and that's anything that doesn't fit under the other headings, and that's the one I was said to be a little bit careful of. And then have a look at how you bring money into the organisation, perhaps grants, donations, charging for services, sales, memberships, and then you might add your own special categories in here. Put in subheadings where they represent significant sums and just check your formulas sometimes to make sure that you're not double counting anything. When you've done that, you'll have an estimate of what the figures will be in each category. Remember, you're not costing what you did last year or even what you're doing now. You want to know what it will cost to deliver those objectives that you've set out in your strategic plan, the things you want to achieve in the coming year. In making this estimate, you can draw on all the available information, what the figures were like last year, what grant applications you have in at the moment, and what the demand for your services is presently like. But at some point, you will always have to make the best guess possible. You can't know whether this year, for the first time in living memory, it will rain on the day of the fete, but you can't wait till the day of the fete to find out either. So a sound rule is to be conservative about estimating income and expansive about estimating expenditure. If you're genuinely unable to come to a conclusion, draw up two budgets, one optimistic and one less so, and that means that you'll be prepared when you eventually find out. So here's an example budget. You can see that this is a small organisation that does have staff, so this is included. Your organisation may not have all of these categories, but you can see that we have included expenditure last year, what we actually spent, and what we have spent this year, and what we think might spend next year. So this is our prediction. A budget might also include explanatory notes, such as if there's a large grant coming in that you know you've already been awarded, and you might include a note about this so the committee understands the change. It's also a good idea to have someone looking at if the budget's on track, getting those regular reports, having a look at actual expenditure versus budget, and having a look at the plans. So sometimes when we get to about this point, people have asked, does the budget always need to be balanced each year? And the answer to that would be, well, it depends. So running at a small deficit is okay if you know that you have the resources or future income that you're expecting. But large deficits can put the organisation at risk of trading insolvent, which we'll look at in a sec. So insolvent trading is when, of course, we don't have the ability to pay our bills as and when they fall due. So the definition of this has changed a little bit. It used to be when you didn't have the funds, that was it. You had to shut up shop. That was the end of it. Now it's changed a little bit, and it could be explained as when you can't pay your bills. This may exist merely due to a temporary lack of liquidity, whereas insolvency is confirmed if the insufficiency represents an endemic shortage of working capital. In other words, if you have no idea how you're going to pay the bills, then you're probably looking at trading insolvent, whereas if you know that your grant's coming in next month, then you've just got a liquidity problem. The main takeaway here is that whilst in many cases there's technical insolvency, if you're still able to meet your obligations, you're fine. And the other really important issue here is not so much with being insolvent. The problem is when you continue to trade whilst insolvent. You know, that idea of, oh, look, if we just trade for a month, we'll be able to make some more money and get ourselves out of this hole. If you're insolvent, you need to put the brakes on the organisation and cease to trade and look at putting the organisation into administration. So, in addition to these 5 one-hour sessions, my colleague John will be coming up to Dysart on Saturday the 11th of June to go into more depth around some of the topics we will cover in these online sessions. It would be a great opportunity to meet face-to-face with the rest of your community doing all of these fabulous volunteering and to ask John some questions. He's an absolute guru on some of these topics that Laura and I have been covering. So also before that, on Thursday the 2nd of June, we've got a social media webinar from 6 to 7, and that will tell you all about using Facebook, Twitter, TikTok, Instagram, all of those things, and not just using it, but how to use it best and how to get into the analytics and how to get into the back of the systems. That should be a good one as well. So put in your diary Tuesday the 2nd of June and Saturday the 11th of June all day for the face-to-face workshop. As usual, we've got some additional resources here for you that you might want to dive deeper into, including our advice guides and help sheets. We have, as before, a really great resources section and a policy guide. And this one here, Damn Good Advice for Treasurers, you can download that for free. It's about 20 pages and really, really targeted to the not-for-profit and community sector. It's a really good resource. So unless we have any questions from anyone, I'd like to thank you for your attention. I hope this has made finances and budgeting a little bit clearer, and we look forward to seeing you at the next one. Thank you very much for joining us today. We hope you enjoyed it. You'll be receiving an email in the next couple of days with a link to a quick online survey, as well as a link to the recording of this webinar. Please do take a few moments to complete the survey and share your thoughts with us. Your feedback is really important, and it will help us design the future webinars we're offering in support to help you do even better in Dysart. We look forward to having the pleasure of your company again. Thank you. Bye-bye.